Hello, my name is Samantha McAllister, and this is the 2.5 assignment mini case study. In this presentation, I'm going to provide an overview of the case study, examples of T accounts and journal entries in relation to how inventory is procured and translated to cost of goods sold, the adjusted journal entry for the company, and some recommendations on how to prevent this adjustment needing to be made in the future. Mr. Onius is a manager of the purchasing department for his company and is in charge of forecasting expenses. He received an engineering estimation of 11.22 pounds of polyurethane foam within the refrigerators that are manufactured. However, $350,000 worth of polyurethane foam was missing after an inventory count. Thus, an adjusted journal entry had to be made to account for the $350,000 of polyurethane foam that was missing from the inventory. The resulting journal entry portrayed a $350,000 overage to cost of goods sold in comparison to Mr. Onius's forecast. I have prepared some example journal entries to show how inventory ultimately impacts cost of goods sold, as well as the adjusted journal entry. Regarding the March 1st journal entry, inventory is an asset and accounts payable is a liability. When an asset increases, it is entered as a debit. When liabilities increase, they are entered as a credit. Thus, the entry shows $200,000 debited to inventory and $200,000 credited to accounts payable. This shows a company purchased the inventory on account and still needs to pay the $200,000. Regarding the March 11th journal entry, cost of goods sold is an expense in inventory, as mentioned previously, is an asset. When an expense increases, it is entered as a debit. When an asset decreases, it is entered as a credit. Therefore, cost of goods sold was debited $125,000 and inventory was credited $125,000. When looking at the T account, the inventory T account shows a debit of $200,000 and a credit for $125,000. Since the debit was more, the total amount remaining stays on the debit side. Accounts payable only had a $200,000 entry, similar to how cost of goods sold only had the $125,000 entry. In order to ensure the accounts are accurate, I added up the debits and credits to make sure that they matched. In order to create the adjusted journal entry, I had to enter a cost of goods sold, which is an expense, and inventory, which is an asset. When expenses increase, they are listed as a debit, and when inventory decreases, it is listed as a credit. This is portrayed in the journal entry being presented on the screen. When adding into the T account, cost of goods sold has a debit for $350,000, and inventory has a credit of $350,000. The sum of the debits and credits, as a result, match. In order to prevent the cost of goods sold discrepancy in the future, I recommend the following. 1. Run a limited production. 2. Compare the monthly forecast versus the actuals. And 3. Source a cheaper supplier. Due to the 11.22 pounds of polyurethane foam being an estimate, I would advise to run a limited batch of refrigerators first. Once the limited production has been ran, an inventory count should occur. This would have shown a smaller discrepancy than running an entire production for an entire quarter. Based off the findings of the limited production, a new forecast can be made with a better understanding of how much polyurethane foam is actually going to be used in the refrigerators. If a limited production cannot be performed due to the customer demand, the findings team should look at the actuals versus the monthly forecast. Given quarters and businesses are 3 month intervals, if we divide $350,000 by 3, we could have possibly seen a $116,667 discrepancy instead. Mr. Onius could have been notified of this 1 month discrepancy and could have brought a smaller discrepancy to the Vice President of Operations before it got as far off forecast as it had. Lastly, the purchasing team can continue to source for cheaper suppliers to be able to meet the company's financial goals better. Overall, this overage has been a learning experience for the company.